Right, hello and welcome to Forex Foundations. So in this little series, in this little chapter, we are just going to be introducing you to the Forex markets. Now this is more aimed for beginners, but I thought it's important to cover before we actually dive into the rest of the course. So we're just going to talk a little bit about what Forex is, who trades it, when can we trade it, and all of these little things. And we'll also talk through some jargon and get you prepped with the principles before we dive into it. So Forex is the name given to the foreign exchange market. It's global markets where the value of currencies are traded against one another. The Forex market is the biggest market in the world, with a daily turnover of only over $6 trillion. Now what this means is $6 trillion passes hands every single day in the Forex markets. It means it's a very, very big market, and there's a bit of money to go around for everyone who knows how to trade it properly. So the Forex market has multiple different market participants. We've got institutional players like banks, hedge funds, and financial institutions. And then we also have individuals like me and you. So diving a bit deeper into the market participants, the individuals like myself and you, we are called retail traders. Now we make up the largest volume of traders. There are more retail traders than there are banks, hedge funds, institutional trading firms. However, despite making up the highest number of traders, the dollar volume that we actually push through the market is significantly less than these institutional market participants. So the banks, the hedge funds, the trading firms actually make up over 90% of the daily dollar trading volume that passes through currency markets. This means they've got a lot of influence over currency valuations. They actually have the power to move prices. Now, we do not as retail traders. We just simply do not have the capital. The hundreds of billions that are pushed through the market by these institutional players, we don't have that. So we are small fry in the larger process of everything. But we can still succeed if we know what to do. So the Forex markets are actually very flexible. They're open 24 hours a day, 5 days a week. They only close for the weekend. Now in London time, they are open from 10 p.m. Sunday to 10 p.m. Friday. That gives us the entire week to trade. And from there on out, the market closes for Saturday and all of Sunday day until the evening, and then they crack open once again, ready to trade. So they are very flexible markets. We can actually trade them any time throughout the week, except for, of course, the weekend. Now, this makes them more flexible than stock markets, commodity markets, except for, of course, we can actually trade some commodity markets in the currency markets. And futures markets, all of these things, they're closed for the week. They close, out of trading hours. 5 to 9 p.m. and then they are closed. 9 to 5 p.m. and then they're closed. We don't have that. We can actually trade through the day, through the night if we want to. So they're very flexible markets. The only market that's more flexible in terms of trading hours is the cryptocurrency markets, which are actually open 24/7. As they're decentralized, that means that they are not ran or, there is no central entity. Of course, being currencies, it is a bit more centralized, but cryptocurrencies are actually open 24/7 now. Despite that, I do believe that Forex traders, we have more tradable opportunity because the crypto markets can have a lot of consolidation and a lot of crazy movements that are hard to actually manage, hard to gauge, and can actually cause some problems. So in my opinion, and the opinion of many Forex markets, are the most flexible and most tradable markets out there. So despite being open 24 hours a day, 5 days a week, there are actually various different trading sessions that we need to be aware of. Now, during some of these sessions, market movements become faster and sometimes slower. So what are the major trading sessions and when should we actually be trading? So here we have the time zones of each major market session. We've got London session, which is the UK trading hours. Now that is in London time. This is 8 a.m. to 5 p.m. Okay, so from 8 a.m. to 5 p.m. London time, the London session is open, and this is where the UK market participants, those banks are open, the institutions are open and trading in the markets. We also have the New York session, which comes in then at 12 p.m. to 9 p.m. Now this is midday to the evening in London time, that is, and the New York session is the second largest volume session. Now London is where the most currency traders, the UK is where the most currency traders are actually active, and most of the trading volume is UK based. However, New York as well is a big participant in the market. So from 12 to 9 p.m. we also have the volume of the New York traders. Now, when I say volume, I'm talking about the amount of money, the amount of orders, the amount of people actually active in a market. Okay, so the higher the volume, the more interesting the markets, the more the opportunity. We also have got Asia session then from 11 p.m. to 8 a.m. Now this is a bit of a different session. We do get a bit of volatility that picks up through the Asia session. Now this runs through the night for London time, and it's not something that I often trade. Based on the timings, I'm usually asleep. But we can actually get some increased volatility and some market reversals happening through the Asia session. So when are the best times to trade now that we know about each individual sessions? So based on the volume that I just spoke about, and the volume being high between the London session and the New York session, and especially in that crossover point when the New York session opens and the London session is not yet closed, the best time to trade is through that London and New York session, okay, the crossover there between 12 to 5 p.m. UK time. So this is where the highest volatility is in the market, and this is where most of the trading volume goes down. This is where we get the biggest price movements and the biggest trading opportunities. So from there on, 5 p.m. GMT, when the London session closes off, we do see a slowdown in volatility, a slowdown in the market movements. Until then, the Asia session comes back on and picks back up. So the best time to trade really is going to be that little bracket where the London and New York sessions are both open. Now, it depends on your style of trading, I will say this, because some traders, long-term traders, you don't even really need to worry about sessions. Of course, you can use them to get into faster movements. But if you're a long-term trader, you don't really have to worry too much about when you're entering your trade and exiting it, because we are looking to hold through multiple sessions anyway. So we'll learn a little bit about sessions when we're actually talking technicals and showing some examples. But for now, just get aware with these sessions and understand that the best time to trade is going to be through London and New York crossovers. So the Asia session, as mentioned, can actually provide some fresh volume, some fresh volatility, some fresh movements for the market. And some pairs, depending on the currencies, will actually also form reversals through the Asia session as well. So while London, New York is going to be the major trading session for movements, we can get some movements in the Asia session, potentially if you wanted to do night trading, or that session suits your time zone more. So that's all for this video. We've spoken about a few Right, so in this video we're going to be talking through some of the market terminology that we will be encountering throughout the rest of the course. So there are various Forex and trading related terms that if you are a beginner you may not have seen before. We did speak about volume and volatility in the previous video, and I don't want to confuse anyone when we actually get into the learning. So before we actually do dive into that, before we dive into the course, we will talk about some of this market terminology. So there's not too much to discuss. There are a few things, a few different market jargon terms that we need to get familiar with, and here are a few of them. We'll start out from the top. So pips. Now pips you'll hear quite a lot. This is actually how we measure profits. So it's how we measure changes in currency values. Now in the next video we are going to talk a little bit deeper into pips, and I'm going to show you how pips work and what one pip is, how to measure pips. But for now, just understand that pips are how we measure changes in currency values. So we've got long, which is a reference to a buy trade. Okay, if we buy a market, we go long in that market. So when I say long, I mean we're buying a currency. Now on the flip side of that, if I say short, that means we're selling a currency. Okay, so we have long trades and short trades, and that is a buy trade and a sell trade. Important to get that out of the way because it's ingrained in my mind now. I'm often going to use the words long and short instead of buy and sell. So if you get familiar with that now, you're not going to get confused when I start talking about long and short. Now, it doesn't actually refer to times. So a long trade is not a trade that we're in for a long period of time. A short trade is not a short-term trade. Okay, if we are talking about an intraday, well, a trade that happens within one day, that's going to be called an intraday trade. Okay, so it's in intraday. When we say short, we are not talking about time frames. We're talking about the direction, which is a sell trade. So we also have got then confluence. Now this is one that we need to talk about because I'm going to say it a lot. A confluence is a reason to enter a trade. Now, when I say we have one confluence, that means there's one reason to enter a trade. If I say we have multiple confluences, that means we've got multiple reasons to enter a trade. And we do need multiple confluences to actually enter a position. So that's what a confluence is. It's just simply a reason to enter or not enter a trade. So volume, we spoke about volume in the previous video briefly. As to not confuse anyone, volume is the market trading activity. So the amount of participants, the amount of active trades in a market. Volume and volatility come hand in hand. Now when we've got high volume, we generally have high volatility. Volatility pretty much refers to price swings. So if we've got high volatility in a market, there are a lot of pushes up and down. If we've got low volatility, the market is generally moving sideways. So liquidity, very similar. Liquidity refers to orders in a market. Now, if I say we have liquidity somewhere in a market, it means there is a lot of orders waiting at that level. You're going to learn much more about this, but for now, think of liquidity as orders. Okay, how many buyers or sellers are active in a market at a specific zone or level? And finally, a retracement. So this one, a retracement is a pullback in the overall trend in a market. So if we have a market that is going up overall, and then the market pulls back down temporarily, and then continues higher, that pullback down is a retracement. So that is essentially the basic Forex terminology that we need to talk about. Right, so hello and welcome back to Forex Foundations. In this video, we're going to be talking about what we trade and how we trade it. So in the Forex markets, we are trading currencies. Now specifically, we are trading currency pairs. When we trade the currency markets, we are trading one currency versus the other and looking to profit from value changes. So a currency pair is a crossover of two currencies, and it allows us to buy or sell one against the other. So here's an example of that. The Euro USD. Now this is the most major currency pair, Euro USD. And that means that it is the most traded currency pair with the highest volume, the highest amount of money that flows through it day to day. So the Euro USD allows us to trade the value of the Euro versus the value of the US dollar. And that means we can actually buy Euro USD and we are looking for price to increase versus the US dollar. So here's an example. When we buy Euro USD, we are betting that the price of the Euro will go up against the value of the dollar. If the price of the Euro does then go up against the value of the dollar, we will make money. If, however, we buy Euro USD and then the Euro falls in value versus the dollar, we will lose money, okay? But we can actually profit from it fall as well. We can sell the Euro USD, and what that means is we are expecting the price of the Euro to fall against the price of the US dollar. So sell trades are called short trades, buy trades are called long trades. We'll get a bit more into that in a moment. Right, so we have different types of currency pairs, okay? The major currency pairs are the most traded currency pairs, the pairs with the highest volume, and these are the pairs that give us the best trade prices. So that means we have the best commissions, we have the best spreads. Now the spread is a difference between the buying and selling price that you can actually buy and sell a currency pair at. So the lower the spreads, the better. It means we can make more money and it means we don't get caught out so much by the broker. So the major, the most traded currency pairs, and the major trading pairs are Euro USD, so the Euro versus the US dollar, USD JPY, the US dollar versus the Japanese yen, GBP USD, which is the Great British Pound versus the US dollar, and USD CHF, which is the US dollar versus the Swiss franc. So as well as the major currency pairs, we also have minor currency pairs. There are 14 minors, and with the amount of volume that actually trades through the currency markets, as we mentioned in the first video, with that $6 trillion daily turnover, the minors do trade very, very similar to the majors. So there's not too much of an issue with trading the minor pairs. The issues arise with spreads and commissions when you actually move on to some of the lesser traded currency pairs like exotics, okay, where we start trading, for example, the South African rand and the peso, the Mexican peso. So the minor currency pairs then are Euro GBP. Here are some of the key ones anyways, the best ones to trade in my opinion. Euro GBP, that is the euro versus the Great British Pound. GBP AUD, now AUD is the Australian dollar, so that's the pound versus the Australian dollar. We then have the pound versus the Japanese yen, the euro versus the Japanese yen, the euro versus the Australian dollar. CAD is the Canadian dollar, so CAD JPY is the Canadian dollar versus the Japanese yen. CHF JPY is that Swiss franc, Japanese yen, and odd JPY, Australian dollar versus Japanese yen. So those are some of the top minor trading pairs that you can actually go and trade day to day without any issues. Right, so we spoke about the different ways to trade. We have long trades and we have short trades. Now, a long trade is when we buy a market. So if we long Euro USD, we're actually betting that the euro is going to go up versus the dollar. So if we long Euro USD or buy Euro USD, and then the euro does rise in value against the US dollar, we will make money. If we short Euro USD, okay, which is a sell trade, we are betting that the euro is going to fall in value against the dollar. So when we go short Euro USD, we will profit if the euro loses value versus the dollar. So that's what's so great about the Forex market and the fact that we trade crosses and currency crosses, is we can basically profit from upside and downside movements day to day. So looking now at pips. Now this is how we measure our profits. Can be a little bit confusing to start with, but you will get into it. You will begin to understand it a little bit more clearly, hopefully with this video. Now, when we are looking to measure our profits, we can do so by measuring pips. Now, when we're looking at stop loss sizes and profit target sizes, of course, all going to be covered later on, we will be doing that by measuring pips. Now, here's an example of a currency quote. GBP JPY 137.450. So what a quote shows is that one currency is equal to this amount of another currency. So GBP JPY, for example, is the Great British Pound versus the Japanese yen. So what this shows is that one Great British Pound is equal to 137.45 Japanese yen. Okay? And these currency quotes is what we are trading. We are basically trying to catch a price difference in these currency crosses, these currency valuations. So 137.45, we have 137.45 Japanese yen in every individual Great British Pound. To count the pips, we go to the far right, so where it says 0.450. And what we actually want to do is ignore the final decimal. That is 1/10 of a pip. So the one we want to target on, the one we want to focus on is there, okay, the second from the right. And what we actually are then looking at is this as 1 pip. So for example then, if the market is riding at 137.45 and it moves to 137.46, we have gained 1 pip of value. Okay, if it falls to 137.44, however, we have lost 1 pip of value. Now, if GBP JPY was to increase from 137.45 to 137.55, that would be a 10 pip increase. If GBP JPY rose from 137.45 to 138.45, that's going to be a 100 pip increase in the market, okay? So basically we want to catch as many pips as possible, but we're going to get into all that later on. It is just important, however, before we get into all of the chart work and the actual methods learning, that you understand what a pip is and how we actually measure our profits. So that is how we would measure profits for the GBP JPY currency pair. There's another example here. For Euro USD, this is the value of the euro versus the US dollar, as we were speaking about. This one, 1.1875, tells us that 1 euro is equal to 1.1875 US dollars. Okay, so they're very similar, but there is a difference there. What we would do again is go to the far right and ignore the final decimal. So this is 1 pip, second from the right. This is 10 pips, and this is 100 pips. So a movement from 1.1875 to 1.1986 would be a 111 pip difference, okay? Does that make sense? When this moves, it's 10 pips. When this changes, it's 1 pip. And when this moves, that's a 100 pip difference. So that's how we measure our pips. And that is how we are going to be essentially deciding where to put stop losses, where to put targets. All of that, if you don't understand, we will be getting into soon. So that is it for now.